If the same style is followed for quite some time, why is it that the funds have actually underperformed during 2018 to 22 period, and it seems like they have a turnaround in the last few years? Why is that so?
Yeah, I think a lot of errors, if you have to look at 18 to 22 period, we did a lot of errors.
One is it's a concentrated portfolio.
Sure.
Two is the turnover ratio is really high, and the third is favoring the stocks that are being favored by the market itself. So you know the framework really well. I mean, you've been doing the
Right.
day in and day out grunt work. Do you agree with these observations?
But roughly it's a 20 stock portfolio, right? And when you run a 20 stock portfolio, you have to be quite focused on risk. Our faction in 21, 22, 23, 24, at all points of time you would have seen our top holdings changed over the 2-year period. Is because we bought something, it became 5x, we booked it, moved to something else, right?
We see ourselves as a part of a client's portfolio, which is the reality and not whole of the portfolio. Similarly, vice versa, if you choose an LMC first, you can go into a flexi cap, very little overlaps. Come to us for growth, pair us with the best of value. In the market, when value works, that guy will work. When growth works, we will work.
Niket, thank you so much for joining us today. So, I want to bring out the style and the nitty-gritties of the investment philosophy that you are following.
Sure.
Also, firstly, congratulations on most of your funds doing really well in the last few years. So, why don't you tell us in brief about the QGLP framework that you follow?
Yeah, so I think QGLP framework really, Q stands for quality, quality of management, quality of growth, quality of earnings. G stands for growth. Fundamentally, we don't like to buy businesses which are less than 20% earnings growth. And most of the businesses should at least grow at 20 to 30% higher than the GDP growth, bare minimum, on at least top line. And with some margin expansion, at least have more than 20% bottom line growth. L stands for longevity of the growth. So we don't want companies to do very well for 1 or 2 years and then not do well for the next 2 to 3 years. We at least try to look at businesses which are a little more structural in nature, and the growth longevity is far more, at least 3 to 5 year period. And then P stands for price, which is obviously the big debate in this time, where what kind of valuation that you really get into. And I think you would tend to get companies at reasonably or lower valuation, provided you are early in the cycle. If you're late in the cycle, you're definitely going to buy them at higher multiples, and obviously sell them at higher multiples later on. But if you're early in the cycle and if you're able to discover an idea quite early, then I think the multiples are pretty much in your favor as well. So that's what QGLP really stands for.
You know, when we listen to the investment philosophies, it sounds very intuitive, like a very commonsensical, you know, buy at a reasonable price and buy good companies, all of this. But there are different styles, and if you could explain how the QGLP framework reflects in the things that we as investors see in the fact sheet, like the performance, returns or the ratios, how is it different when it compared to the other styles? How can we see that?
So I think, for us, there are some sectors and some stocks where we have a complete no-go area as such. So if you look at most of our portfolios, you wouldn't find metals, for example, because they're highly cyclical nature. You wouldn't find too much cement in our portfolios. Because fundamentally, if you look at cement prices in India over the last 20-25 years have been same. Steel price broadly, give or take, has been same. So it's effectively only expansion of capacity which drives growth, or reduction of cost which will drive growth in some period of time. So in some sense, we don't like to buy businesses which are cyclical in nature. So if you look at our stock holdings also today, you would find one extremely high quality of management, right? Management which have the fire in the belly to really take it to the next level. Would typically be a very large part of our portfolios, right? You can have great businesses with very bad management and a bad businesses with great management. Both of them don't work. You need great businesses with great management, right, to have that lethal combination. So that's where our focus is. So if you look at our large holdings, you would find at least managements with far more aggression as compared to other peers in that industry, right? So that's the first part of it. On quality of earnings, I think what we also tend to focus a lot is on cash flows, right? Rather than just the P&L growth, right? So we look at cash flows, free cash flow from operations, is a working capital. I mean, our company is using the balance sheet to grow their P&L. All of those And over and above that, how is the capital allocation policy? Right? One is that you generate a lot of free cash flows. Second is how do you deploy that free cash flow? Right? If you're deploying in wrong areas, obviously that's a clear recipe for accident. So we don't generally look at businesses where capital allocation is not adhered to. So we look at companies which are very, very sensible when it comes to capital allocation, very, very cautious when it comes to capital allocation. So I think when you look at a portfolio, you will find businesses and growth which are structural, very high quality management typically will have fire in the belly to do something very large, and third is very, very strong on capital allocation and governance. We would not really go down the path of buying businesses where there is any issues with the promoter in the past at all.
Understood. Is there any change in the style of managing the funds in the last few years? I'm asking this question because the same style which you've been following for quite some time, if the same style is followed for quite some time, why is it that the funds have actually underperformed during 2018 to 22 period, and it seems like they have a turnaround in the last few years? Why is that so?
Yeah, I think a lot of errors, if you have to look at 18 to 22 period, we did a lot of errors, right? And when you analyze those errors, I think first error was, if you go back in time, you would realize that we were always very good on ideation, right? So we were great buyers of stock, great identification of ideas or themes. We were way ahead of that. But the problem really lied is selling. We never sold our winners. Right. So, for example, say you look at an auto company, right? You bought a right auto company at say 100. If it becomes 400, right? And if you don't sell it, right, and you hold it, thinking that it will continue to own for the next 3-4 years, and then comes COVID, and then you have chip issues. So for 3 years, that company wouldn't have given you any returns, right? And would have dragged on your portfolio. Because we run concentrated portfolio, we have to be quite focused about risk. So it's a great quality company, no error that the company would have made, but there was just no chips during COVID. Now, frankly speaking, we should have taken that call to move out of it when it became quite expensive on valuations from 100 to 400. But we never did that, or at least reduce weights or reduce risk in the portfolio. But we never used to do that. So we made those changes, right? Second is, we were in some sense also slightly behind the curve on ideation. So right now, if you look at our focus is to do ideation before, be ahead of the curve, at least by a couple of quarters, right? So we typically tend to buy something which is not in cycle, not in favor, at least a couple of quarters before, and it has to have some meaningful catalyst for it to really change. So for example, look at the food delivery business. In India, food delivery business was, from 2016-17, it was quite prevalent and kind of kept growing from strength to strength, but it was always loss making. But no one knew when this loss would kind of go up and, they will start charging you a convenience fee, and then people will start paying for it, and then they will start making money, right? So no one knew that inflection point. We could clearly see that inflection point happening, right? Ahead of the curve by at least 1 quarter, right? And that's where we went all out on that particular theme. Now, when you buy them early on a particular theme, you tend to get it at a lower multiple by design, because the consensus earnings would have been say X, and suddenly you realize that the profit is actually 2 or 3X, right? And then the valuation suddenly looks much more cheaper if you have that projection in mind. So that, I think, was again a big change that we did, is be ahead of the curve, buy reasonably large size allocations, and you buy businesses where risk reward is in your favor. So because you are early in the cycle, you can buy companies early at lower multiples, where downside risk is far more lower and upside is like 2x, 3x, 4x. And then that time, you can actually have far more larger allocation. Instead of having 1 or 2% allocation, you can go with 6-7% allocation, right? So that essentially is quite important for us, where we have very high conviction, we do a lot of detailed work, and if we get a winner, we will just go all out. Right. So that, I think, kind of, those are 2 major changes that we did. Focus more on selling. So if you look at our faction in 21, 22, 23, 24, at all points of time, you would have seen our top holdings changed over a 2-year period. Is because we bought something, it became 5x, we booked it, moved to something else, right? So identify a theme, buy the right stock in that theme, make reasonable amount of money in that theme, exit it, move to the next theme. Next theme, new stocks. So keep doing that virtuous cycle over and over again. and then broadly you would be in a very good position.
What I have a doubt here is when we talk about QGLP, because in the QGLP framework, the L is also longevity. Like, if we are talking about longevity of growth, also the quality of the companies, then how does this higher turnover ratio aligns with the framework that you have?
Yeah, so while we look at longevity of the growth, but we also have to keep in mind that markets have become very, very fast, right? They discount things virtually at rapid pace, right? So you identify a particular theme, it does reasonably well. In just matter of 1.5, 2 years, the stock becomes 5x, 6x, discounting FY 28, 29 earnings also sometimes. In those periods, if we don't book profits, then we're doing the same mistake that we did in 18 or 22, right? In that duration, same mistake we used to do. Used to buy a right stock, does very well, but you don't take money off the table, right? And we don't take money off the table if it becomes a little expensive. We know, okay, it might consolidate for some time, that's perfectly fine. But if it becomes extremely expensive where it is very tough for us to justify on valuations, right, then we will have to take a call to exit and move to something else within that sector or something else within another sector or another theme. If you don't do that, then you're stuck with losers in your portfolio. And it's a very dangerous situation to be in, because then what happens is you bought a stock which has not done well for the last 1 year, which has done well for the first year and then doesn't do well for the next year. And then you can't sell also and move to something else, because it's like selling your losers and buying the winners, right? Which is a very dangerous combination to have. You should do the other way around. Sell your winners and buy the companies that are not doing well this year and expect that cycle to turn around next year. So that's the way the whole cycle really works, and essentially that is what we have been focusing on.
Now with the funds doing very well, it's all over YouTube. If you see, I mean, your funds have been talked about, and some of the observations that have been made by the people who are analyzing these funds are for the wonderful performance of the funds lately. One is it's a concentrated portfolio.
Sure.
Two is the turnover ratio is really high, and the third is favoring the stocks that are being favored by the market itself. So you know the framework really well. I mean, you've been doing the day in and day out grunt work. Do you agree with these observations?
So let's look at it one by one, right? So I think first is obviously concentration. It also depends on how the economy is doing. Right. So for example, 2021, which is post-COVID, to 24, the economy was extremely strong, was very, very wide. Government spending was reasonably strong. All the high frequency indicators were like, there was just no slowdown in that 3-year duration. Reform process by the government was again quite strong. And we saw a lot of sectors participating, right? Defense coming out in a big way. Railways had its own share of ups and downs, but obviously did reasonably well in that duration. And when the economy does very well at broader scale, lot of sectors fire, right? Now, in the last 1 year, we have seen some slowdown in economy. All the high frequency indicators are signaling that, including GST growth, right? Now, when the economy slows down, the market tends to become more narrower, right? And if I keep a wider portfolio of say 35, 40, 50 stocks, what will happen is 25 will do well, 25 will not do well, and I'll end up with the same position. So I have to have more sharpness this year and identify the right sector, whether a catalyst or the growth path is something where there will be earnings upgrade in those stocks. So earnings upgrade and earnings downgrade is very, very important feature of our stock selection, right? If a business where we believe that the consensus expectation is say 10 rupees of EPS, and if we believe it can do 20 rupees over a period of time or 15 rupees over a period of time, that means there will be meaningful earnings upgrade, right? And that is a very, very important indicator for you to make higher returns in a stock. So in a year like this, we have to become more and more sharper. We have to identify just the right amount of stocks which will do very well this year. And we've done that in the past as well.
And yeah, it's been usually a feature of Motilal Oswal funds, right?
Yes, we do very, very sharp positioning. That's something that we were not doing maybe in 18 or 22. And over a period of last 4-5 years, we have tried to master that art that every sector or every theme, just try to identify the right stock in that theme, right? Because when you look at say tech, there are so many companies in tech. I can't buy everything of that, right? So I have to identify which one do I buy. Right? Can I buy those 2 best ones out of it? Can I buy 2 best startups or best 2 platform businesses? Can I buy 2 NBFCs or something like that? So the idea was to identify the highest return stock of that theme or sector, much early in the cycle, right? It's like a wish list, right? And we used to do that. Now this year is specifically because the economy is slowing down. There are only very few stocks which are actually growing at more than 25% earnings growth, right? And to ensure we buy those businesses where there is 25% plus earnings growth, we have to narrow it far more this year, right? Because of economy doing, not doing so well. So it's a factor of how economy does. And if you look at 2018-2020 cycle, which is after just after GST, again economy was not firing up all cylinders. You would have looked at the market was extremely narrow in that duration. We are in some sense going in that same duration or same journey. And I would think that from this year as well as next year, market will be narrower, right? Not all stocks will do very well. Some stocks will just not do well, and only few stocks will, drive the index up higher or drive the mid-cap index up higher or Nifty higher. And we have to identify those stocks, be in those stocks before the cycle starts, and in reasonable amount of allocation as well. So that's, I think, the important thing that we did at.
With respect to concentration.
Yeah, that's respect to concentration.
But the risk also will be higher because that's what we are tend to, say it again and again that, with the higher concentration comes the higher risks.
Yes.
So what do you say about the risk?
We have to be good sellers. We have to identify risk because, we typically have 6 or 7 large holdings and then we also have a bit of a tail. But roughly it's a 20 stock portfolio, right? And when you run a 20 stock portfolio, you have to be quite focused on risk on a particular business.
Absolutely.
Now, if there is risk which is visible, it's easy to identify. Risks which are beyond your control, like a US tariff on India, beyond control. You don't even know what Donald Trump is going to do tomorrow. Impossible to fathom. The best thing is not to do anything in that time. Let it happen, let it play out. Common sense will prevail over a period of time for both the countries. So I would think that in such duration, we will just stay put, right? It's like cricket, every ball you can't hit a 6, right? You have to take 1 or 2 runs sometimes, sometimes you have to defend the ball, and whenever there is a full toss, you will go for it. So we have to be quite, focused on risk. And if you're again going back to 2021 to 25 period, you look at every year, all our large holdings that we had in our portfolio, we have fully exited pretty much at the top, right? And moved to something else. So it also requires very strong focus of projections of earnings, right? Which I at least try to do myself for most of my companies, right? At least on funds which I have very large allocation on, I will do the earnings model myself, right? Obviously the team also does it, the analyst also does it, but I like to do it myself because that's how I get sharpness on it. Otherwise, it's very impossible to, understand where next couple of years earnings are going to go, what are the moving parts in the business model. You can only do it when you do your own earnings model, right? And hence you get a little more sharpness than otherwise you would have got without having an earnings model. So I think when you project earnings quite sharply, you exactly know what can be like the peak the stock could go to. And if it crosses that, then you better sell it.
And that explains the higher turnover ratio.
The higher turnover ratio is also due to the fact that sometimes we do take hedging calls, right? So for example, you buy a stock which is say 8-9% of the portfolio, you think it is run too fast, you hedge it, right, in futures. Now when you hedge it, you tend to roll it over, right? So it gets double counted when you sell it and again you buy it back, or you buy it and sell it back again. So it gets double counted, and hence our turnover ratio would look slightly on the higher side. Otherwise, generally our turnover ratio is in the range of 50 to 70%. But as the size has become larger, it will further come down.
Okay, I'm also again very curious to understand this. Your framework talks about quality growth, but if we see the performance has been actually been more aligned during the time period when value stocks have been favored by the market, at least from March 2023 to September 2024.
Sure.
Why is that so?
Well, frankly speaking, I'm not a big believer of value and growth. Because fundamentally, if a stock is at $100 and its profit is 100 crores, for that stock to go from 100 rupees to 500 rupees, at least the profit has to go from 100 crores to 400 crores. If the profit remains at 100 crore, I don't think the stock goes from 100 to 500 rupees, right? So I'm not a big believer of value versus growth, but fundamentally within the house, we only follow growth, right? And growth plays out across cycles. If you buy a great business early in the cycle, where they continue to go at 25-30% plus earnings growth, and there is earnings upgrade in that cycle, great quality management, and it's a tailwinded sector where the industry growth is far more higher than the GDP growth, and the company that you have is gaining more market share in that same industry. when it's fully tailwinded, then you tend to get disproportionate return irrespective there is value, irrespective there is growth, doesn't matter what style works on that point of time, right? If a business profit goes from 100 to 200 crores, doesn't matter which year, which cycle, whether it's 2008 cycle, whether it's COVID cycle, the stock would have still gone up by 2 times. The profit would have gone up by 2 times, right?
You say it's nothing to do with the cycles?
Nothing to do with cycles, just earnings growth. So we only focus on earnings growth. We don't even predict next year value will do well, growth will do well. We only chase earnings growth. It's like a complete Hawkeye view. Like we only keep focus on earnings growth. And in some sense, what Ramdevji keeps saying is like vision to see, courage to buy, and patience to hold. So you need to have that vision to see that this industry will do very well over the next 2-3 year period, right? And if you're able to spot far early in the cycle, then you have a gold mine which you can literally milk it, right? For example, food delivery businesses, we got very early in the cycle, right? In Jan 2023, we have been riding that cycle all the way through, right? From $50 all the way through. So that's how we tend to do with most of the businesses.
Currently, in the current market where the valuations look a little bit stretched, at least in the mid cap and the small cap space, how do you look at your style fitting in this current market scenario? So
I think again, the economy obviously when it kind of slows down and the reform process aren't happening at a far more rapid pace than what it used to happen in the past 3-4 years. Generally what we tend to do is don't make meaningful changes in the portfolio, right? And keep looking out for catalyst or big triggers, in the economy. Like for example, look at electronic manufacturing in India. Irrespective whether the country is slowing down, we are still seeing a lot of focus from government on electronic manufacturing. That's like a single focus area. Look at Apple manufacturing in India. It's already crossed more than $15 billion, right? And continues to grow over the next 3 to 4 years. Now, when you have that kind of situation, you keep looking at businesses where you can get a meaningful entry because you know that this is a big focus area and the runway of growth is very, very strong for the next 2-3 years. At the same time, then we look at, how tariffs are going to play out, and then we figure out that, okay, if tariff of India is far more lower than other countries, this will be again a big tailwind. So you have to keep those in mind, and you will still get 1 or 2 ideas in that year, which will really do very well for that year. So in some sense, when we did an exercise where we realized that irrespective of how the economy does, irrespective of how the cycle does, if you strip out COVID and 2008 kind of cycle, which is like a black swan event, every year you get 1 large cap which gives you more than 50% return, right? And more than 3 mid caps which give you more than 50% return, right? Okay. You just have to identify that. That's essentially what we get paid for.
Understood, brilliant. And now, what are the risks that come with this kind of framework? So, an investor who is investing in Motilal Oswal funds, what should the kind of risk that they should be aware of? I mean, everything comes with its own share of risks, underperformance, outperformance. So, what is it that they have to think of?
No, I think one risk that we tend to run at all points of time is if non-quality stocks do very well, right?
When did it happen?
It happened, I think, in 2023, right? But we have an ideation for that as well. How do we ensure it doesn't hit us? So, for example, say you look at some of the PSU names when they do very well, right? Some of the metal names when they do very well, it will obviously hurt us quite bad. And when we see that cycle starting, we broadly know their composition of these businesses in the index, right? For example, let's say 15% for argument's sake. And if you know that 15% is these companies, set of companies, say whether it's PSU or non-PSU, doesn't matter, but 15%. And this can double it. And I can't buy because it's not quality. It doesn't fit in my quality filters, right? Then in that case, will have to backfill it with something else which will give me 2x return for that same allocation, right? So if I lose 15% of the index weight, if I'm losing 100% return, I will have to allocate 15% to some stocks which fits in my filter and yet give me that 100% to backfill for that loss.
How?
That's what we are all up to, right? So you have to buy, again, same thing, you have to buy early and you keep hunting for ideas because India is such a large country with so many things happening on a daily basis that you have to keep hunting for ideas on a regular basis. So in case we are unable to get that, in that year we will underperform.
Understood, yeah. Finally, Niket, As an investor, how do you want your investor to have an experience when they're investing in your funds? And what is your top priority in terms of performance or in terms of risk, drawdown, etc.?
Yeah, so look, I think every individual has in some sense, a temperament of how he wants to run a fund, right? The reason why we run concentrated funds, because we buy high quality. If you buy low quality, you can't run concentration. It's like blowing up. You just can't blow up the whole thing, right? So because we buy extreme high quality businesses, high quality management, we still know that even after concentration, we will not have meaningful drawdowns, right? Secondly, I personally don't like businesses with high drawdowns, right? So if you look at, there are some businesses which are very, very cyclical in nature, and the stocks, like across cycles, they will go up 2x, but they'll fall down also 50%. I'm not interested in making 2x return, but I'm more worried about that 50% erosion. So by design, my nature is, my temperament is not to take that 50% hit. It doesn't suit my temperament. So if I think about a business which I'm going to invest or a company that I'm going to invest, for me, the first thing which comes to my mind, how much can I lose? How much will I make is secondary. How much will I lose? If I'm unable to lose, if I think that even in stress situation, the downside is only 15% or 10%, and the upside is 4 or 5x, very high quality business, I will just go in, right? I will not look at who are the shareholders, who is a selling guy, nothing. We will just go in, right? And that is the conviction that we want, to be known for, and that is the conviction that we bring on table, right? If we get something which is like a gold mine or something, we will just not wait for anyone else. We will just go in with enormous amount of force. And the second thing that we also tend to do is be very, very agile. So you make a mistake, realize that that's fine. Everyone out here is a human being, right? We are not God. That will not make any mistakes. But if you make mistake, realizing that mistake is very important. Rectifying that mistake is even far more important. Even if it requires to book some losses and move to something else, please do it. But carrying the burden of a mistake for years is extremely dangerous, right? So identify a mistake where you think that you've done something wrong. You thought about a particular business or a cycle in such a way it's not playing out for whatever reason it is. Please change your course. Please, rectify mistakes and move forward in life.
Absolutely. Very well said. Thank you so much, Niket. That's all from our side.
Thank you so much for having me here. Thank you.
This is about the fund managers and then, the track record. The second thing that readers want to know about a fund house is the skin in the game. Of course, for those who don't understand skin in the game, it is the mandatory regulatory requirement where it asks the key personnel or the key employees of the fund house to invest some part of their compensation or the salary in the schemes that they are managing, so that their interests or the fund manager or the fund management team's interests are aligned with the interests of the unit holders. Now, Prateek, how much are you investing of your salary in Motilal Oswal funds?
So by regulation itself, all managers have to invest 20% of what they earn post-tax happily in the funds that they have been managing in the proportion of AUM of a fund. For people who manage managers, their money goes into all the funds that their team is managing in the proportion of AUM of the scheme. So if I had the AMC, my money goes in all the funds of the scheme. I have something left, lot of that also goes into our schemes.
Understood.
Not in anybody else's scheme.
Okay. So the skin in the game is very thick.
And this is true, by the way, for most of our managers.
Okay.
And I would believe many of our employees as well.
Is it the demand from the CEO of the fund house?
No, it is not a demand while we cajole them, but it is their money. They have opted, at least I believe so, that they are opting more and more to choose our own funds rather than outside funds.
And of course, I think it has rewarded very well in the last few years.
No, so they started to do that after seeing some good times.
Yes. Right. You've taken over as the CIO of the fund house in the last couple of years. So what's your top priority? What are you bringing to the table, Prateek?
First, to have a positioning. We are an industry of 46 fund houses. Soon we will be 60.
Absolutely.
1550 schemes. So if you do what everybody else is doing, you won't grow. So you have to have a distinct positioning, and we spoke of that. We say we are very good, we say we are best at growth style of investing. We say we run focused high conviction portfolios. So you see the whole house is between 20 and 35 names, except of a large cap fund and a small cap fund. Everything else is between these two numbers. Also on the alternate side, by the way. So we do what we do best across the house, the same stuff. And then once there is a philosophy, there is a product which is true to philosophy, you then communicate it to the public, to our prospect clients, saying that this is something which has worked in the past with examples, etc. This is what we are doing. This is what we will continue to do. It's not that today we are doing, we will continue to do. If you like what we are doing, come to us. Journey will be volatile, but we believe over a period of time outcomes will be good. So just to flesh it out a bit, there is another thought that we share, which is this is time for alpha. Alpha is excess return over large cap index, for example. Now in the story that I shared with you, excess return will happen if you get a space which gives you higher growth delta over index.
Can you explain that?
Yes. So for example, in 90s you got a space called software, where you got 80-100% kind of growth for 10 years, and that space generated huge alpha for the investors. You got another space called private sector banks, again a small space, grew 2x, 3x index growth rate for 15 to 20 years, generated alpha. In the same manner, many of these spaces today would many participants of capital market do it, would electronic manufacturing do it, would renewable do it, would electric vehicles do it, we don't have any is another matter, new tech do it, and so on. We think this is the first time.
AI
not there in the market, but yes, data centers not there in the market, but yes. So this is the first time that we are getting so many new spaces all at once, that is allowing us to build portfolios of these new spaces only. Not possible before. And hence we say this is time for alpha. We have been saying this now for 2.5+ years and doing it.
So you don't see any threat from passive funds?
We see a lot of threat from passive. So great question, I will fly of this. If you have too consistent, so just think of it. There is this huge desire to have consistent performers. Now to me, consistent performance means index does 10, you are consistent if you do 12, you are consistent if you do 10. Which then means if you have two consistent guys, check your investor how many they own. Most investors would own 8-10 funds. 2 will make average same as index, and then you are paying active management fees. That will get passivized. The other thought is have differentiated funds, whole platter of fund, 10 funds, okay, and people manage long funds, 80, 100, 120 names. If you have 10 funds, you end up owning 500, 600 stocks. It is the market, and you are paying fees for it. That will get passivized.
Interesting.
We say, if you want active management, there are two styles of making money. One is growth. We think we are best at that. Have us for what we do best. If you can take volatility, it works over long period of time, and we equate with, let's say, a Nasdaq which is more volatile, higher beta, but over time works better than S&P 500. If you want more consistency on your $100, not only on your $100, pair us with the best of value. In the market, when value works, that guy will work. When growth works, we will work. And to ensure that we work when growth works, we have all spaces, like I told you, of which offers growth of the variety we want. Team fleshes it out, we encourage managers to include all of them in the portfolio with as evident a name as possible. You will say a theme is working when these names are working.
This is very interesting because a lot of the fund houses I have met before also, they talk about consistency in performance, as you said. Again, for the US also, the consistency in the performance is not without drastic up movement or down movement. But here we have him, Prateek, Mr. Prateek, saying that they are not focusing on consistency.
We say publicly across forums that we will be consistently inconsistent. To us,
consistently
inconsistent.
Wow.
Consistently inconsistent, because if our constructs are 90+% deviant to the index, which is required if you are a return focused house, okay, you can't be consistent because you measure consistency with the index. When you are doing well, it almost seems like you chose well, the investor chose us well. But if the fund construct is such a large deviation to the index, when index works, you will not work. So we say we will be consistently inconsistent. So which is why I say, we try to do what we do best. We try and communicate what we do, and hopefully we want investors who want what we do. So they are happy, we are happy.
I really have to appreciate you for saying that out, Mr. Prateek, because it's not often said, but consistently inconsistent. I mean, kudos to you for saying that out loud. But I have the follow-up question on that. Exactly when an investor wants to take out that money, and if the fund house is not performing, I mean, does the objective of the scheme or the fund house been achieved?
No, so in equities, we encourage investors to come in with time on their side. Okay, one should not come into equities with 1 month, 2 months, 3 months, 6 months, 1 year kind of view. It has to be with monies that they would not really require over multiple years, and then over that multiple years there would be a period when markets typically do very well, growth style of investing would do very well, is when we say people should have asset allocation, take out some monies from what is doing very well, farm it into something else. So that is how it works. We don't say invest all the money into one asset class and one style, because then if you need it, it won't be available, or if you take it out, you will not feel so nice. So the basics have to be followed, asset allocation, and we said pair us with the best of value and all of that, and give yourself time. In equities, giving yourself time is very important.
Yeah, I think the message is very clear. I mean, when you actually talk to an investor, you're saying do not put 100% of your money with us. I mean, if you want a consistency, then pair us with some other fund.
I'll explain to you. There was a time when there was only one fund house, one fund, Unit 64. How they used to think may have some relevance till you had 8-10 fund houses, and each client had 3 or 4 funds. But today when you have 15-50 plus schemes, and everybody that I speak to has over 10, doing it the traditional way, managing longer funds, constructs, is actually making an investor own the market, and the returns then average market, and you are paying active management fees. So we need to rethink our value proposition to the client. I don't believe a client owns us only. We see ourselves as a part of a client's portfolio, which is the reality, and not whole of the portfolio. Similarly, vice versa, if you choose an LMC first, you can go into a flexi cap, very little overlaps. Come to us for growth, you will get very little overlap between two managers. If you want different style, whole house is growth. If you want different style, go to the best of value.
The message is very clear.
Very clear.